Hey everyone, welcome back to Corporate Dakota, the place where we look at big company secrets to help you make smarter choices about your money. This quarter, FinWise Bancorp seems to be making some interesting moves, and we're going to decode what it all means for their customers and their investors. First off, like any company, they're telling us that some of what they say might be about the future, and future stuff isn't always certain. They use words like may, might, and will likely, which tells you they're not absolutely sure about what's coming ahead. This is pretty standard for companies because the future is always a bit fuzzy. Now let's dive into the numbers for the 3 months ended June 30th. FinWise Bancorp brought in $497,000 in net income. That's up from $31,080,000 in the same period last year, showing a nice jump in their profits. For the first 6 months of the year, they pulled in $7,286,000 compared to $6,495,000 last year. Again, a solid increase on Qs. But here's where it gets interesting. Their net interest margin, or NIM, which is basically how much profit they make from lending money compared to what they pay out on deposits, dropped significantly. For the 3 months, it went from 10.31% last year down to 7.8% this year. That's a pretty big dip. And for the 6 months, it went from 10.9% down to 8.03%. This means they're earning less on their loans relative to what they're paying for deposits, possibly due to lower interest rates or a shift in their loan mix. A 2% drop in IM is a big deal, 3%. This means they're earning less on their loans relative to what they're paying for deposits, possibly due to lower interest rates or a shift in their loan mix. A 2% drop in IM is a big deal, and 3% drop in IMM is a big deal and could mean tighter margins for the company. Looking at their income sources, strategic program fees jumped up to $504,000 from $4,000 from $435,000 in the same 3-month period last year. That's a good sign, as it shows their partnerships with tech companies are growing. For the 6 months, these fees increased to $10,366,000 from $8,000. This is a key area for them, and it's good to see it growing. Coin and fees to $5,000. This is a key area for them, and it's good to see it growing. They also saw a big jump in their gain on sale of loans, going from just $356,000 in the 3-month period. That's a massive increase of over 300%. For the 6 months, it went from $771,000 to $2,000. That went from $771,000 to $2,329,000. This suggests they're selling more loans, perhaps to manage their portfolio or to generate quick cash. And then there's credit enhancement income, which went from a tiny $39 to a huge $275,000 in just 3 months. This is a really interesting one. It seems to be tied to certain loans where other companies guarantee the losses. This jump might mean they're taking on more of these types of loans, or that the guarantees are becoming a bigger factor. This could be a way to boost income, but it also introduces a new layer of complexity and potentially risk if those guarantees don't hold up. On the expense side, salaries and employee benefits went up substantially. For the 3-month period, it rose by almost 22% from $8,609,000 to $10,400. That increase was even steeper at 25.6% from $1,617,1,000. Over 6 months, that increase was even steeper at $2,525 to $2,316, and $1,000 over 6 months. This increase was even steeper at 25.6% from $1,611,000 to $20,031,17,000. This likely reflects growth in their workforce, perhaps to support their new programs and expansion. Let's talk about their assets, particularly the loans held for investment net, which increased by a significant $508,691,000 to reach $5,653,000. This growth in their core lending business definitely shows they're putting money to work in loans. Overall, their total assets grew by over $96 million to $84.25 million. For a company of their size, that's a pretty substantial jump, and it's mostly going into loans. This indicates they're actively lending and expanding their loan portfolio. Now, looking at where they get their money, deposits are their main funding source, and they saw a big increase here from $54,495,200 to $63,574,000. This jump is largely driven by brokered time deposits, which went up by $90 million. Brokered deposits can be a good source of funding, but they can also be more expensive and less stable than core customer deposits. Their total shareholders' equity also grew by over $8 million thanks to their profits. That's a healthy sign showing they're building up their capital base. However, we need to look closely at the risks in that growing loan portfolio. The non-accrual loans to total LHFI ratio saw an increase, especially for their SBA loans. It looks like almost 11% of their residential real estate loans and over 16% of their construction and land development loans are not paying as expected, while the company's allowance for credit losses to total LHFI for these categories is lower. That could be a potential red flag if these loans start defaulting in larger numbers. Their strategic program loans that are held for investment are particularly noteworthy. The allowance for credit losses on these loans is a very high 28.3% of the loan amount. This means they're setting aside a lot of money to cover potential losses on these specific loans. This is a clear indicator that management sees higher risk here, possibly due to the nature of the borrowers or the program itself. Scroll, CEO and Chairman Scroll. Looking at leadership, Kent Landvatter as CEO and Chairman, along with Robert Warman as CFO, are guiding the company through this growth phase. While their net income is up and asset growth is strong, the decline in net interest margin and the high allowance for credit losses on certain loan types are areas to watch closely. To wrap up, FinWise Bancorp is clearly growing and expanding its loan portfolio, especially through its strategic partnerships. However, the drop in their net interest margin and the significant allocation for potential credit losses on some of their strategic program loans suggest that this growth might come with increased risk. Their reliance on brokered deposits also adds a layer of funding cost and potential instability. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps. And subscribe for more deep dives. And don't forget to check out our Discord in the description. Thanks for watching. See you next time.